Hello, and welcome to another case study by Blueprint to Escape. Today we are doing something a little bit different.
Yeah, we're not looking at a generic article or a book today.
Right. We are looking squarely at a portfolio review for mid-February 2026, and also looking ahead to their plans for March 2026.
It's a really instructive snapshot in time, honestly.
It is because, well, the market threw a bit of a curveball here.
Exactly.
And right at the top of this case study, there's a headline number. The portfolio is currently generating an annualized yield of roughly 15%.
Right. Which sounds it sounds great on paper.
Yeah, 15% usually gets people excited. But I think we need to take a cool-headed approach here.
We do. And the Blueprint team is actually very clear about this in the notes. They aren't popping champagne over that 15%.
No, they actually say they'd prefer it.
Around 12 or 13%.
Right. And the difference between 12 and 15%, I mean, it's not actually that great of a difference in the grand scheme of things. It's just something we should mention because it highlights a mechanical reality of income investing.
Exactly. It's the yield paradox. We really need to explain the math behind that rise because it acts as a mask for the volatility underneath.
So yield is just the distribution, the income, divided by the share price.
Correct. So if the cash payout stays exactly the same, but the capital value of certain holdings drops,
The denominator shrinks.
yes, the price goes down, so the yield percentage automatically goes up.
So it's not that they're suddenly making more money, it's that the portfolio took a bit of a hit,
Right, the capital value dipped. We're looking at paper losses about 10% for the month.
which is noticeable. So let's look at the why behind that volatility. Where was the capital dip coming from?
It was very specific. It was the high beta sector.
The stuff that usually moves fast.
Yeah, technology, blockchain, Bitcoin-related assets, data centers.
Tech.
Exactly, those were the culprits.
The case study calls out two specific ETFs here, HAS and HBTE.
So HHS was down 13% in total return.
It hurts, but
But HBTE is the real drag here. It was down 29% in total return over the last 30 days.
29%.
Yeah.
That's a serious haircut. What exactly is inside HBTE that caused that?
Well, it holds things like iron and Robinhood ticker hood, plus other tech stocks that just had a really weak start to 2026.
The Mag 7 kind of stumbled, right?
They did, and when the big players stumble, these smaller high beta components just plummet.
So the obvious question for you, looking at this case study, did the team panic? Did they sell off HBTE to stop the bleeding?
No, they didn't. They held firm.
They kept those diamond hands, essentially,
You could call it that, yeah. They actually continued a dollar cost averaging strategy.
buying all the way down.
Right. Because they view this as a long-term play. The 10% paper loss on the overall portfolio doesn't change their thesis on blockchain or data centers for the next 5 years.
Right. You have to have a strong stomach for that. But it's easier to have a strong stomach when the other side of your portfolio is doing its job.
And that is the perfect transition.
Yeah, let's look at what is actually working here, the pivot to defense. Because the portfolio relies heavily on defensive sectors to balance out that tech volatility.
We really need to spend some time talking about HUTE.
Yes, HUTE,
Yeah.
the Harvest Equal Weight Global Utilities Enhanced Income ETF.
It was the absolute star of the Canadian and global side of the portfolio in February.
Let's contextualize that performance,
Yeah.
because the broader markets weren't doing much.
No, the S&P 500 was pretty flat. The TSX was sluggish, but HUTE outperformed both of them year-to-date in 2026.
Okay, so what is under the hood? It says global utilities.
Right. It's not just Canadian utilities. That's the key. It provides stability and scale because you're getting exposure to U.S. utilities, national utilities, energy
Like lines.
pipelines, communications. It's a very broad, very stable base.
And why does that matter so much for this specific case study?
Because of the broader market theme, while tech was turbulent and dragging down HBTE, utilities provided the necessary counterbalance.
People still pay their power bills even if Bitcoin drops.
Exactly. It's a non-cyclical cash flow. And that's what keeps the overall portfolio stable.
It's the barbell approach. High risk on one side, extreme stability on the other.
Precisely.
All right, I want to move over to the U.S. portfolio narrative because this is about 20% of their total holdings.
Mostly in their RRSP.
Right. And again, the market context here is important. The S&P was flat, and the NASDAQ was actually down about 2% for the month.
But the U.S. holdings in this portfolio bucked that trend completely.
Let's put the spotlight on two specific winners, starting with ASGI.
The Abranen Global Infrastructure Income Fund.
Infrastructure. It sounds so boring.
Boring is beautiful in a flat market. Look at the numbers. ASGI had a 10.85% price increase.
Just in the price.
Just the price.
Yeah.
When you look at the total return, which includes its monthly yield, it was 12.91% in the last 30 days.
Almost 13% in a month.
Mm.
That is notable for infrastructure.
It is. But it makes sense when you look at the asset. It's a diversified global portfolio of infrastructure companies. So you have energy, utilities, transportation, communications.
Toll roads, airports, cell towers, real things.
Exactly. Real assets. When the market gets nervous about tech valuations, money flows into tangible assets.
Okay, and the second U.S. winner is ET, Energy Transfer LP.
Which is actually the portfolio's longest-held U.S. position.
And it had a great month, too.
It did. The price increased by 9.39%.
And the total return?
11.45% over the last 30 days.
Wow.
Plus, it has that quarterly distribution structure, which gives it a solid 7% yield.
So what's the big takeaway here? You got QT, ASGI, and ET all doing the heavy lifting.
The lesson is that in a month where tech faltered and the NASDAQ was down, these boring infrastructure and midstream energy sectors provided double-digit returns.
It really validates the strategy of not just chasing growth stocks.
Exactly. You need the foundation to hold the house up when the weather gets bad.
Let's look at some of the minor moves and adjustments they made in February. The notes mention a new addition, CANY.
Yeah, CANY by Evolve.
It says here it was actually suggested by a viewer.
It was. They're testing it out. It's a very small addition, less than 1% of the portfolio.
What's the profile of CN?
It focuses on Canadian financials, energy, and communication. The interesting part is the bi-monthly distribution.
So it pays out twice a month.
Yes, and the annualized yield is hovering around 20%.
That is aggressive.
It's very aggressive. That's why it's less than 1% of the portfolio. It's a test to see how it performs.
They also made a move with HDIV.
Right. This is a classic rebalancing move. They took profits from HMAX to reinforce HDIV.
Because HDIV is one of their core holdings, right?
It's a critical anchor. It makes up 16% of the total weight.
And how did it do during the February turbulence?
It held its value much better than the high beta stuff. So moving profits into it is a way of securing those gains.
Taking chips off the table.
Exactly.
Let's circle back to the HBTE problem. We talked about how it dropped 29%. The case study says they want to reduce it.
They do. They want to get it down to 5% of the total weight.
So why haven't they sold it yet?
Because of the timing. You can't sell aggressively while it's down that much. You'd just be locking in a huge loss.
Right, you're trapped by the price.
You are. The holdings inside HBTE, like Iron and Hood, they have betas above 3 or 4.
Meaning they are incredibly volatile compared to the market.
Extremely volatile.
Okay.
So the team is basically waiting for a price recovery before they start trimming that position.
You just have to sit on your hands and wait.
Yeah, patience is mandatory with those assets.
Okay, looking forward. This is the plan for March 2026. Despite all this focus on income and defense, they are not ignoring growth.
Not at all. And the big standout here is Google.
They are continuing to accumulate Google.
Which makes total sense for them. The notes mention the team has past career experience working with or for Google.
So they know the company culture and the mechanics from the inside.
Exactly. They have strong conviction in the technology. They aren't worried about the short-term noise. They see long-term value.
And they're also looking at international diversification, specifically Latin America.
Right, using the ticker ILF. That's the iShares Latin America 40 ETF.
Why Latin America right now?
It's a materials and resources play. They have a lot of conviction regarding copper and lithium.
The battery metals.
Yeah, for 2026. Plus, there's a strong fintech component in that region, so they are continuing to accumulate ILF.
It's a good way to get outside the North American bubble.
Definitely.
Now, there is a section here titled consolidation, and it uses a term I think we should explain. Worsification.
Yeah, worsification. It's what happens when you diversify so much that you actually start hurting your portfolio.
Just collecting ETFs for the sake of it.
Right. And the Blueprint portfolio is nearing 30 holdings.
Which is too many.
Way too many. It's an administrative headache, and you end up with overlapping assets.
So what's the housekeeping plan for March?
They want to consolidate the overlapping Canadian financials and utilities. So tickers like HHE, ECI, UTS, Bank, and HMAX.
They're going to merge those into fewer, stronger positions.
Exactly. The stated goal is to get down to a sweet spot of 20 to 25 holdings.
Make it leaner and more efficient.
Precisely.
All right, I want to wrap up by looking at the broader picture. For someone listening to this, you might be trying to understand the core philosophy behind these moves.
Yeah, what is the actual blueprint approach?
Right. There are 4 pillars listed here. Let's walk through them. Pillar 1 is capital preservation first.
This goes back to the yield discussion. Do not risk your principal just to chase a high yield.
Because if the capital goes to 0, the yield doesn't matter.
Exactly. Pillar 2 is growth with resilience.
Which means aiming for scalable monthly income, they target that 8 to 18% range.
But importantly, relying on assets like HGT and ASGI to provide that resilience when tech drops.
Right. Pillar 3 is risk management.
This is strict. No single holding can be greater than 15% of the portfolio.
And they keep a small carve-out for speculative plays.
Yeah, keep 5 to 10% for fund investments. That's where CAN or HBTE fits in.
It keeps you engaged without betting the farm.
Exactly.
Yeah.
And the final pillar, pillar 4, is stoicism.
Which might be the hardest one to practice.
It really is. Invest with conviction, not emotion. Don't chase the daily trends. When a holding drops 29%, you don't panic sell.
You review the thesis.
Right.
And we should tie this back to the lifestyle connection. Because this portfolio isn't just a spreadsheet exercise for the blueprint team. It funds a specific life.
It supports a nomadic expat lifestyle.
Right. They have a home base in Canada, but they're traveling.
So they are investing in both Canadian dollars and US dollars to support that.
The income has to be reliable because it's paying for the flights and the rent in different countries.
Which is exactly why you need that defensive base we spent so much time on today.
Well, that covers the mid-February review and the March plan. Before we go, I need to read the mandatory disclaimer.
Of course.
Please remember that this case study is for educational and entertainment purposes only. This is not financial, tax, or legal advice. You should always do your own research or consult a professional before making any investment decisions.
Apply the concepts, but do your own homework.
Exactly. And to you listening, we'd love to hear from you. Please post your comments or questions below. What did you think about the pivot to utilities?
Yeah, we read all the comments.
And please subscribe for more content regarding financial independence, passive income, early retirement, and nomadic life design.
It really helps the channel.
Do you have a final provocative thought to leave everyone with?
I do. When you're looking at your own holdings, always remember the difference between total return and yield. A high yield means absolutely nothing if the underlying asset is eroding away. You have to look for that balance between income and stability, just like the infrastructure plays we discussed today.
Total return is the ultimate scorecard.
Exactly.
Perfect place to end. Thanks for joining me to break this down.
Anytime.
And thanks to you for listening. We will catch you on the next case study.